Hello and welcome once again to Clear Skies Retirement Radio with Jay Kirkwood at Secure Financial Management. My name is Randy Cook. Each week, Jay and I sit down here and kick around some of the things that you might have heard of in the financial news because you're getting close to retirement and for some reason you start watching that stuff. I don't know why, but we're going to go through some of those headlines today and talk specifically about you preparing for retirement and how we might be able to help. Jay, how are you doing today?
I'm doing real well, Randy. How are you out there?
I'm good. However, as I follow the financial news and the Fed and the interest rates and the election and all that goes along with that, it's interesting to me how the headlines kind of just go back and forth like a tree in the wind. It's. I sat down the other day and I looked, and 3 articles right in a row, bang, 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 all about before the end of the year, the market's going to go down 10%. It's going to go down 30%. It's going to go down, worse. And it all happens at once. What do you think that is? That the financial news, one guy says it and then they all jump on the boat? What is it?
Yeah, well, the next guy has to say it's going to go down more. Otherwise, it's not as shocking as what the last guy said.
Okay.
Right? So,
all right.
Yeah, I always caution clients on, hey, watch CNBC, watch Fox Business, watch Bloomberg, whatever it is. Like, you should stay informed. It's great. Remember, they've got to fill like 16, 17, 18 hours of airtime every day too.
Yep.
Right? And they've got to keep people paying attention. And what doesn't keep people paying attention is the boring, important stuff, like make sure you're diversified, make sure that you've got a financial plan done, make sure you know kind of what's in your portfolio and how stable is your financial plan. That's pretty boring, right? It's important, but that doesn't get people tuning the channels in, does it? What does get people tuning the channels and gets us talking, I mean, look at us, we're talking about it, right?
Yes, we are.
The market's going to go down 30% by the end of the year. Maybe it will. I mean, I hope not, right? It might. I can tell you it will at some point. So whoever's saying all this, there's going to be a correction in the market. Guess what? They're going to be right.
You got a great point there.
That's kind of like a weatherman in Texas in August saying, hey, guess what? It's going to get really cold. And if he keeps saying it, eventually February will come around and he'll be right.
Yeah, if you're listening to your favorite talk show, your sports talk show on the radio, and your team is 2-17, and the sports guy is saying, hey, I think we're on the right track, steady as she goes, don't fire the coach, we're in great shape. Nobody wants to hear that. Everybody wants, to climb on board and say, fire everybody, blow the thing up, and we got to do something different. Well, one of those guys who's out there regularly, never says hardly anything positive, is Harry Dent. You may have seen him, and I'm going to play a little clip from his podcast here. There's a little music in here you got to fight through. But here's what Harry says about where we are headed in the stock market.
This bubble's been going 14 years instead of most bubbles 5 to 6. It's been stretched higher, longer, so you'd have to expect a bigger crash than we got in 2008 to 9. This thing has got to blow. It's showing signs of topping here, but we've got to see a crash of about 40%. I can tell you there has not been one bubble, and this is far larger and longer, one major bubble in history that has not ended badly, period.
Run for your lives!
Yeah. 40%, well, you know what that means, right? The next guy has to say 50.
There you go.
Otherwise, it doesn't matter.
Well, right? I heard somebody once say, Harry's been right 2 of the last 20 market declines.
Yeah, but you only hear him talk about those 2, right?
Yeah. Well, I guess he was right in 2008. He did call that, and that is his big claim to fame. But at the same time, you're going to hear this stuff. And now, do you have clients who come in and say, Jay, I just heard a terrible report that we're going down 20, 30%. Do we have to make some adjustments in my portfolio? How do you handle that one?
Yeah, absolutely. That's a common concern. And again, look at the clientele that we're dealing with, the people that engage us and trust us with their wealth. They're not working anymore, most of them, right? They've gone from, and we talk about this a lot, Randy, they've gone from that work life into retirement life, and everything's done a 180 on them, right? I was getting a regular paycheck. from an employer. That's stopped, right? I've kind of have to take care of that myself now. I was accumulating and adding to my retirement savings. Now I'm drawing down on that. Everything's changed. So these sorts of things, no one likes to hear it. But people that are retired, it affects them a lot more, right? Because the consequences are far more significant. So that coming up, and it serves its purpose, as we mentioned before. It gets people talking about it.
So we talk in the financial realm, and they use this metaphor of you have different buckets of money. And if you're taking money out of a bucket and your bucket's also got a hole in it and it's draining because the market is taking it away, it's a double whammy for your retirement accounts. So, I mean, just because the market's going down doesn't mean that you don't need your $60,000, $70,000 a year.
Of course.
It's still got to come out of those accounts. And again, if all you have is market-based money, and the market goes down and you're taking more money, now you're taking, instead of 4%, 5%, now you're taking 10, 14, 15%. And that's how people run out of money.
Exactly right. And, we talked about this on a show a little while ago. I can't remember how long ago it was, but it was the whole idea of people that were going through the 2008 crisis, right? That was, whatever it was, 16 years ago or so. Those people that were in their peak earning years then, they're in their late 40s or in their early 50s, well, they're in peak retirement essentially right now, right? They're in a very different situation to where they were. He mentioned in that clip, it's going to be worse than the 2008. Okay, it's a very dramatic statement. I don't know if he's right or wrong on that. I hope he's wrong, right? Let's just say he's not. That affects a retiree multiple times more than it does that working person. Because for that working person, you're taking them back 16 years in that event, they're 49 years old, let's say, right? And so my 401k's gone in half. Oh no, this is terrible. I hate looking at that. I'm not going to use it for a while, right? So that's the first thing. You don't stop your contributions. You shouldn't, at least. Let's say you don't. So you're still going to contribute. You're buying while the market's down. If you've got an employer match, they're buying in while the market's down. And the big thing that you said, right, is you're not kicking that thing in the ribs while it's down, taking distributions. You were doing the opposite. You were contributing. Not now. If that 2008 event happens now, it's what you said. If you're relying on it for income, maybe you can cut the distribution down a little bit, but you probably can't eliminate it. You probably can't stop it if everything is in the markets and that's what you're relying on. That's absolutely right.
So we have to have something that's generating income for ourselves in our retirement years. It can't be just peeling money off the top, and certainly peeling money off the top of an account that is losing money. So there's got to be something in our portfolio that's going to grow. We've got to, even though we don't think we need growth in retirement, we truly do. So where
Absolutely.
does that come from? So I've got another guy that we see here regularly on CNBC. It's the guy from Shark Tank, Kevin O'Leary. And he says some good things every now and then. But this I thought was very interesting because he was talking about placing your money in a place that gives you money, and that is dividend-paying stocks. He said when he was a kid, he used to go to the bank with his mom, and he learned this.
And she'd take a third of her paycheck and put it into bonds and dividend-paying stocks. After she passed away, I became the executive for her estate. And for the first time, I saw a secret account she kept from both of her husbands her whole life, made up of dividend-paying large-cap stocks and corporate credit. Do you have any idea of the performance of that portfolio? She blew away every indice. I was amazed. I started to do some research. Over the last 40 years, over 70% of the market's returns have come from dividends, not capital appreciation. That forever changed my investment philosophy. I'm a dividend guy. I only buy stocks that pay dividends.
Interesting. So you don't need NVIDIA. You don't need to have bought Microsoft and Apple 20 years ago. There are things today that will pay you. This is part of the planning that you do with people to generate income.
Yeah, absolutely. What Kevin's talking about there is, when you have an equity portfolio, and that could be individual stocks, it could be made up of things called ETFs, which are exchange traded funds. There might be some mutual fund. We don't use a lot of mutual funds, but it could be mutual funds. You are actually now an owner of that company, okay? Be it a very small portion that you're owning of that company, nevertheless, you're an owner. So what do you get to be entitled to as an owner of some sort of business? Well, you should be entitled to some of the profits, right? That's what a dividend is. These are some of our profits. We're going to distribute some of those profits to our owners, which are our shareholders, our equity holders, and you might have that as part of your portfolio. So absolutely, the dividend side of it can be very interesting. I think to take that even a step further, it's about having a real plan. But we talk about different buckets, right? Kind of, hey, we've got kind of our investment bucket over here. We've got our income. We've got our guaranteed, whatever it is. And often what I find people trying to do is to not have separated out buckets, but to have one bucket and say, guess what? This one bucket, I just want it to do everything. And we've got that investment portfolio there. And I want it to grow. I need some income. I need some dividends. And I also don't want to lose anything. And I got to tell you something, right? That's a lot to ask of an investment portfolio. It just is. I want to grow it. I don't want to have too much risk. I want to have some income. What I would suggest to you is that if you're trying to do all those things from your investment portfolio without planning it out more in depth than that, it's going to do none of those things really well. And you're going to be pretty disappointed with it. The best example I give to a client when we're talking about this sort of thing is I say, imagine I sell trucks. And you come to me and you say, hey, I need a vehicle. I need it to do the quarter mile in 10 seconds. I need to be able to haul my 20,000 pound fifth wheel on it as well. And it's got to get at least 40 miles to the gallon. I'm going to give you something that does none of those things really well, but can do all those things, right? Yeah, it's going to be 20 seconds for the quarter mile, not 10 seconds, right? And you're going to get 12 miles to the gallon, not 40. And it can tow a fifth wheel, but only 15,000 pounds. And it's kind of lumbering along doing all these things, but it's what you need is you need 3 different vehicles. That's what you need, right? It's the same thing with your investment strategy and how are you dividing out your wealth. You can put it all in one bucket and say, I want this to do all these things for me. It's not going to do any of them real well. You need to have it separated out with defined purposes for each one.
And for those of us who have been saving in a 401k all these years, we've just been putting our money in that one bucket that Jay is talking about. And the purpose of that is to grow your money, house that money, and one bucket is fine for that. But when you get into retirement, there's a whole bunch of things that your money's got to do that might not be appropriate for just one bucket. Let's talk through that. Give us a call. Give us a look on our website. Website is retire210.com, retire210.com, or give us a call, 210-985-6200, 210-985-6200. Let's talk through your retirement, do your retirement math, give you some confidence as you go into this time in your life. Let's take some of the wondering out of it and put more knowing into these next 20, 30 years that you're embarking upon.